Individual income taxes, 49E, Chapter 3, Tax Formula and Tax Determination, Unit 01, Tax Formula. Tax Formula for Individuals. The impact of the Tax Cuts and Jobs Act of 2017, TCJA. Provisions will expire at the end of 2025 for majority of individual and business, between 2025 and 2028 for others. Various formulas that are part of the corporate international tax provisions are also subject to modification after 2025. Congress expected to act on these provisions during 2025. Other changes are likely to be included in the final legislation. Income, broadly defined. Gross income. The Internal Revenue Code defines gross income broadly as, except as otherwise provided, all income from whatever source derived. Mine in the except as otherwise provided refers to exclusions. Gross income does not include unrealized gains, e.g., stock that has appreciated in value but has not been sold. Includes all of the taxpayer's income, both taxable and non-taxable. The courts have defined income as any increase in wealth. It does not include a return of capital or borrowed funds. Partial list of exclusions from gross income. Life insurance paid at death. Partial list of gross income items, 1 of 2. Alimony, divorces before 2019. Annuities, income element, awards. Partial list of gross income items, 2 of 2. Director's fees, dividends. Embezzled funds. Deductions, individual taxpayers. Individual taxpayers have 2 categories of deductions. Minus deductions for adjusted gross income, AGI. Deductions from adjusted gross income, AGI. Deductions for adjusted gross income, sometimes called above-the-line deductions. On the tax return, they are taken before the line designating AGI. Deductions for AGI include, but are not limited to, the following: trade or business expenses, part of the self-employment tax, contributions to traditional individual retirement accounts, IRAS, and other retirement plans, contributions to health savings accounts, HSAS, interest on student loans, excess capital losses, certain alimony payments, deductions from adjusted gross income, some personal expenses as deductions from AGI minus, referred to as itemized deductions. Taxpayers are allowed itemized deductions for expenses related to the production or collection of income, the management of property held for the production of income. These expenses, sometimes referred to as non-business expenses. Deductions for many of these expenses are suspended from 2018 through 2025. Deductions from adjusted gross income. Partial list of itemized deductions. Medical expenses in excess of 7.5% of AGI, state and local income or sales taxes, real estate taxes, personal property taxes, interest on home mortgage, subject to certain limitations, investment interest, up to the amount of net investment income, charitable contributions within specified percentage limitations. Only $10,000 of combined state and local taxes is deductible. After OBBA, it's $20,000, $40,000, single married. Deductions from adjusted gross income. Non-deductible expenses. Personal living expenses. Employee business expenses, unless reimbursed by employer. Prior to 2018, these miscellaneous itemized deductions were allowed as from AGI deductions, subject to a 2% of AGI floor. These deductions are not allowed from 2018 through 2025, and most have been permanently disallowed in OBBBA. You don't have to remember the crossed out ones. For the first exam, you do not have to memorize all the SLR from AGI deductions. That's what most of the rest of the class is about. Tax formula, correlation with Form 1040. In arriving at gross income, referred to as total income, most exclusions are not reported on the tax return. Form 1040 page 1 includes the most common gross income items. The total of these amounts is reported on line 8 of Form 1040. Deductions for AGI also are summarized on Schedule 1, Form 1040, and used to determine the taxpayer's AGI. Itemized deductions, A from AGI deduction, are carried over from Schedule A, Form 1040, to page 1, line 12 of Form 1040, which is followed by the deduction for qualified business income to arrive at taxable income. Page 2 of Form 1040 contains the tax computation and reductions for tax credits. Knowledge check activity 1. Which of the following is a deduction from adjusted gross income? A. Excess capital losses. B. Contributions to health savings accounts, HSAS. C. Interest on student loans. D. Medical expenses in excess of 7.5% of AGI Knowledge Check Activity 1. Answer. Which of the following is a deduction from adjusted gross income? Answer. D. Medical expenses in excess of 7.5% of AGI. Medical expenses in excess of 7.5% of AGI is a deduction from adjusted gross income. However, excess capital losses, contributions to health savings accounts, HSAS, and interest on student loans are deductions for AGI. Unit 02, Standard Deduction. Standard Deduction, 1 of 4. The standard deduction is the sum of two components. Basic standard deduction. Amount allowed is based on the taxpayer's filing status. Additional standard deductions of $1,600 or $2,000. Available for taxpayers who are age 65 or over in 2025. Blind in 2025 standard deduction, 2 of 4. Additional standard deductions of $1,600 or $2,000. 2 additional standard deductions are allowed for a taxpayer who is age 65 or over and blind. This provision also applies for a qualifying spouse who is age 65 or over or blind, but not for a dependent. Amount allowed depends on the filing status. Standard deduction, 3 of 4. The basic standard deduction amount depends on the filing status of the taxpayer. Basic standard deduction amounts. Standard deduction, 4 of 4. Additional standard deduction. For taxpayers age 65 or older and or legally blind. Individuals not eligible for the standard deduction. Some individuals are not allowed to use the standard deduction. Miney, a married individual filing a separate return where either spouse itemizes deductions. An individual who is neither a U.S. citizen nor a U.S. resident. The Internal Revenue Code refers to these individuals as non-resident aliens. Special limitations on the standard deduction for dependents. Individual claimed as a dependent has a basic standard deduction in 2025 that is limited to the greater of minus $1,350 minus $450 plus earned income, but not exceeding the basic standard deduction. Additional standard deduction amount S still available. 52. Donover, age 15, is claimed as a dependent by a grandparent. During 2025, Donover had interest income from Google Corporation bonds of $1,000 and earnings from a part-time job of $700. Donover's taxable income is A. $1,000, B. 0, C. $1,700, D. $350, E. $3,500. Knowledge check activity 2. Answer. Donover, age 15, is claimed as a dependent by a grandparent. During 2025, Donover had interest income from Google Corporation bonds of $1,000 and earnings from a part-time job of $700. Donover's taxable income is, answer, D, $350. Donover's standard deduction of $1,350, the greater of $1,350 or $1,050, the sum of earned income of $750, partially offsets his gross income of $1,700, resulting in taxable income of $350. $1,700 minus $1,350. Here's your text retyped clearly and organized by unit and section headings. Unit 3 exemptions. 2 types of exemptions. Personal exemptions, dependency exemptions. Deductions are suspended for exemptions from 2018 through 2025. Personal exemptions are granted to the taxpayer and spouse. Dependency exemptions are allowed for a qualifying child or a qualifying relative. Exemption amount in 2025 is $5,200. $5,050 in 2024. Knowledge check activity 3. What is the amount of dependency exemption for the year 2025? A. $5,200, B. $5,050, C. $4,300, D. $4,500. Knowledge check activity 3. Answer A. $5,200. The dependency exemptions allowed for a qualifying child or a qualifying relative in 2025 amount to $5,200. It was $5,050 in 2024. Unit 05, Filing Status and Filing Requirements. Individuals must know their filing status to correctly compute both taxable income and the related income tax liability. In addition, individuals need to understand the tax return filing process, minus determination of filing status and whether a tax return must be filed, computation of tax liability and adjustment for available tax credits. Selection of the appropriate tax form and how to file it with the IRS. Filing status and filing requirements. Every year, taxpayers must determine their filing status. Taxpayers' filing status is important because it is used to determine, mind the taxpayer's standard deduction, whether the taxpayer must file a tax return, the taxpayer's tax liability, reductions of itemized deductions and certain tax credits, eligibility for certain provisions, e.g., some credits are not available when the married filing separately status is used. Filing statuses. There are 5 filing statuses: single, married, filing jointly, married, filing separately, surviving spouse, qualifying widow or widower, head of household. The amount of tax varies considerably depending on which filing status is used. Single taxpayers. A taxpayer who is unmarried, including a taxpayer who is legally separated or divorced, and does not qualify for head of household status, will file as a single taxpayer. Married filing jointly. A legally married same-sex couple is treated as married for federal tax purposes, no matter where they live. Married status is determined as of the last day of the tax year, except when a spouse dies during the year. In that case, marital status is determined as of the date of death. Filing a joint return carries the potential disadvantage. Minus a joint and several liability. The spouses cannot switch to separate returns for the year in which a joint return has been filed. Married filing separately. If married individuals file separate returns, each reports only his or her own income, deductions, and credits, and each must use the married filing separately tax rates. The Internal Revenue Code places some limitations on married persons who file separate returns. Minus, if either spouse itemizes deductions, the other spouse must also itemize. The Earned Income Credit and the credit for child and dependent care expenses cannot be claimed. No deduction is allowed for interest paid on qualified education loans. Only $1,500 of excess capital losses can be claimed by each spouse. Joint filing status also applies for 2 years following the death of one spouse if the surviving spouse maintains a household for a dependent child. The child must be a son, stepson, daughter, or stepdaughter who qualifies as a dependent of the taxpayer. A distinct filing status. Taxpayers filing as a surviving spouse use the married filing jointly tax rates and standard deduction. Unmarried individuals who maintain a household for a dependent or dependents can use the head of household filing status. Must pay more than half the cost of maintaining a household as his or her home. The household must also be the principal home of a dependent. A dependent must satisfy either the qualifying child or the qualifying relative. A qualifying relative must also meet the relationship test. A special rule allows taxpayers to avoid living with their parents. Head of household status is allowed if a taxpayer maintains a separate home for the taxpayer's parent or parents if one of the parents is dependent. Head of household status is preserved if more than half of cost of maintenance is provided by the taxpayer prior to the dependent's death. Abandoned spouse rules. Allow a married taxpayer to file as head of household if the taxpayer does not file a joint return. The taxpayer paid more than half the cost of maintaining his or her home for the tax year. The taxpayer's spouse did not live in the home during the last 6 months of the tax year. The home was the principal residence of the taxpayer's son, daughter, stepson, stepdaughter, foster child, or adopted child for more than half the year. Can claim the child as a dependent. Filing requirements. 1 of 2. General rules. Tax return must be filed if gross income is equal to or exceeds the applicable standard deduction. The additional standard deduction for being age 65 or older is considered in determining the gross income filing requirement. Except in the case of dependents, the additional standard deduction for blindness is not taken into account in determining whether a taxpayer must file a tax return. Special rules apply for dependents and self-employed taxpayers. Filing requirements. 2 of 2. Filing requirements for dependents. Dependent must file a return if he or she has any of the following: earned income only and gross income that is more than the total standard deduction. unearned income only and gross income of more than $1,300 plus any additional standard deduction. Both earned and unearned income and gross income of more than the larger of $1,350 or the sum of earned income plus $450, but limited to the basic standard deduction, plus any additional standard deduction. Would you like me to also create a condensed study sheet?